Breaking news: economy more catastrophic than a recession. We're currently experiencing one of the most unusual periods in human history. This has never occurred before. The Fed has raised interest rates over the past few years in order to get a handle on inflation. But this will ultimately have a catastrophic effect on the housing market and the economy as a whole. This will go down in history as one of the worst housing crises ever. Hello and welcome to Finance Sense, where we cover all the latest trends in the financial markets and the economy. Make sure to leave a like, subscribe, comment below your thoughts, and turn on the notification bell to keep posted. Now, let's start. Extremely unusual things have happened in the last 2 years. After printing billions of dollars, the government is now actively trying to attract trillions of dollars at a fast rate. There has never been a period in history where interest rates have risen as quickly as they are now. Eventually, this will have the greatest impact on the housing market and the economy as a whole. Some individuals find it hard to believe that the housing market will collapse. Concerned spectators will likely wonder how such a seemingly steady sector could suddenly collapse. During the previous 10 years, home prices have been rising every single year. People have been predicting a collapse for years, but prices have continued to grow throughout that time. And indeed, it is precisely what was asserted in 2007, just before the housing market collapsed and prices fell by 33%. People who understood the data, like Michael Burry and Steve Eisman from The Big Short, predicted that home values would decline. They succeeded in earning hundreds of millions of dollars, but no one else discovered the data until it was too late. Our current economic climate is quite similar to that of the recession that occurred in 2008. People often claim that history repeats itself, and right now, that is definitely the case. The current housing market statistic is as alarming as it was in 2007. Consider the U.S. National Association of Home Builders Housing Market Index, often known as the NAB Index. The NAB Index measures the confidence of U.S. house builders, providing us with a valuable insight into the market. The index shows that house builders' confidence has decreased for 12 months in a row, falling to just 31 out of 100. The last time such a significant decline occurred was during the pandemic when shelter-in-place was in effect. Although there are a number of explanations for why this happened, there is really one primary reason. Buyers are unable to obtain mortgages at decent rates due to the current housing market climate. Even if a person wanted to get a mortgage at a higher interest rate, the banks would find it difficult to accept their loan since they know that the market is bound to fail. This explains why there is now little demand for houses. Let's say you're a builder and notice a dramatic increase in the demand for new homes. Building additional homes seemed like the best course of action. As a result, you begin constructing thousands of additional houses in anticipation of increased demand. But by the time you start to complete those homes, demand has long subsided. Unprecedented demand caused home construction to soar to a record highs last year. But that was only possible because the Federal Reserve reduced interest rates to 0% and sparked a massive purchasing frenzy. Numerous house builders are experiencing financial difficulties as a result of the Fed's rate hikes and the lack of demand. Even the properties that are selling are going for a significant discount right now. Moreover, a considerable number of properties are being put up for sale while having an exceptionally poor level of quality control. Nowadays, it's normal to move into a home and find that walls are crumbling or that doors won't close because home builders cannot afford high-quality control. Furthermore, it's a well-known fact that businesses are the first to go when a crisis strikes. Those in the middle class and below have been left holding the bag after investing their life savings. Banks are aware that the housing market is imploding and are fleeing the market as quickly as possible. In the mortgage industry, Wells Fargo is, without a doubt, the leading company. Now, Wells Fargo is leaving the mortgage business, and in a recent announcement, Wells Fargo stated that it will be cutting its entire mortgage division worth $1 trillion in loans. Moreover, Wells Fargo has opted to limit its home loan offerings to existing clients and minority communities. The bank will also stop making any more purchases of loans from other lenders. A decline of this scale in the mortgage market has not happened since 2008. During a recession of 2008, both Bank of America and JP Morgan Chase reduced the size of their mortgage divisions, which cost them market share they never recovered. When the ship sinks, the captain is the first to abandon the ship. Consider the time during the 2008 recession when Fannie Mae needed to be bailed out. Fannie Mae acquired loans from banks and other businesses, repackaged them, and then offered them to investors. From this, lenders would receive more funds that they may use to fund additional loans. Then, Fannie would charge a fee to ensure that the borrowers would repay their loan, and investors would receive these outstanding mortgage-backed securities. In a recent report, Fannie Mae stated, results suggest that the housing market may be more vulnerable than previously thought to rise in mortgage rates. Fannie Mae is well aware of the dire state of the housing market and has been for some time. The Fannie Mae National Housing Market Survey is a tool that assists Fannie Mae in making choices regarding its mortgage operations. The current survey indicates that the market will only continue to decline in the following years. The survey found that 76% of American adults believe that now is not a good time to purchase a home. If home buyers dry up, where does it leave the housing market? Housing prices will decrease. These days, fewer people are applying for mortgages than in 2001. As a result, consumers are not only not applying for mortgages, but banks are also refusing to give them. Although the government is aware of this, they do not want the general public to know. Based on a leaked video from the Federal Deposit Insurance Corporation, or FDIC, the government is withholding information from the general public. The FDIC wants to protect the public from learning about its profound lack of confidence in the present banking sector. As stated by the FDIC, information should be available to those who need to know, but they have little chance of reaching those who do not have a professional need to know. They are nearly convinced that releasing this will cause widespread panic. The FDIC argues that you need to consider the unwanted consequences of taking a public with more faith and trust in the banking system than they do. In addition, the FDIC expects the general population to place complete trust and confidence in the banking system. Meanwhile, the current housing market climate is costing banks hundreds of millions of dollars, and they are in danger of going out of business. But the general public shouldn't be aware of this, right? If the general population knew how vulnerable the financial system is, the entire economy would collapse. Everything rides on public trust, and just like the calm before the storm, no one is aware of its impending arrival until it's too late. So we now know that no one wants to purchase a home, banks are unwilling to offer loans, and the government has lost faith in the banking industry. However, this does not give us the complete picture, as we have yet to discuss the rental market. A low level of confidence in the rental industry has rendered many tenants unable to make decisions. U.S. apartment demand has changed for the first time since 2009 in a negative direction. In previous years, we've seen a significant increase in apartment rental demand once college students moved into rental apartments near or after graduation. But as of this moment, the opposite happened. Some would argue that this is a result of college students finding it difficult to find jobs in the economy, but that is incorrect. According to employment statistics, most college graduates have gotten jobs after completing their degrees. Therefore, the only explanation is that despite having jobs, college graduates still opted to stay with their families because of the unstable housing market. The rising popularity of this decision is seriously impacting the rental market's demand. Meanwhile, evictions are also taking place at an alarmingly high rate, which makes an already difficult situation for landlords much more difficult. Tenants' failure to pay their rent has led to an increase in eviction filings in cities around the country. This is because the government prohibited landlords from evicting renters during the pandemic. Landlords found it challenging, if not impossible, to evict renters due to laws like the COVID-19 Tenant Relief Act. However, landlords are evicting tenants at an unprecedented rate now that government aid for tenants is reducing. Consider the situation in Minnesota, where eviction filings have surged by 6,800% since April 2020. By passing laws that let renters not pay their rent, cities like New York City have attempted to stop mass evictions. Now, some renters capable of paying their rent are exploiting these laws to their advantage. There have been protests against such laws, but the landlords' efforts to garner support have been unsuccessful. These policies have a limited lifespan, which is their biggest downside. The more they put out the inevitable, the worse the results will be when they finally have to deal with the consequences of their actions. As previously indicated, this is the first time in 14 years that there has been a decrease in the demand for new apartment leases. If no one moves in, the apartments will remain vacant. Massive vacancies would be disastrous for the rental market and the economy as a whole. The overall housing market is in serious jeopardy, and things will only get worse from here. Alright, that's all for this video. Leave your thoughts in the comments section below, and don't forget to like, subscribe, and hit the notification bell to stay up to date on our videos. Here at Finance Sense, we'll make sure you're up to date on everything happening in the world's economies and financial markets. Keep yourself safe and never stop educating yourself. We'll see you in the next video.